In this video, we want to look at net exports more specifically and what governments can do if they, are in a trade deficit or a trade surplus, and they want to think about, fiscal policy. And so, in order to do that, we need to go back first to the real exchange rate. And so we had this equation from Chapter 17, where the real exchange rate is equal to the nominal exchange rate, which is E, times the ratio of the domestic price level to the foreign price level. And that's really important because the real exchange rate puts real turns, foreign goods into domestic goods and vice versa. So our definition of net exports is exports, which are already in domestic goods because we made them domestically, minus imports, which are foreign goods, and so we have to convert them into domestic goods so we can add them up, add apples to apples. So we have to divide by the real exchange rate. And then we said, all right, well, we know what exports and imports depend on. Exports depend on foreign income and the exchange rate with a negative sign. And imports, which we're subtracting out, depend on domestic output and the exchange rate with a positive sign. And then we're dividing by the exchange rate too. Now, so what this is going to mean is that the real exchange rate is very important for net exports, right? It's going to affect exports and it's going to affect imports through two channels. It's going to affect imports through the relative price, but also through how they get converted into domestic goods. So this is called the Marshall-Lerner condition. Basically, it just says that a real depreciation leads to an increase in net exports, or, of course, a real appreciation leads to a decrease in net exports. So a real depreciation means that exports are going to go up because exports are now relatively cheaper. Imports are going to go down because imports are relatively more expensive. And then the relative price of foreign goods in terms of domestic goods, that 1 over epsilon, where we divide imports by epsilon, increases as well. So when we have this depreciation, right, so if the dollar gets weaker, for example, then that leads to a shift in demand towards domestic goods, both because imports are more expensive, so we don't buy them as much in the United States, and our exports are cheaper for foreign consumers, and so they buy more of them. So that's domestic goods for us as well. So that means that that shift in demand is going to lead to an increase in domestic output and an improvement in the trade balance. And so, if we think about, some criticisms of China, 10, 15, 20 years ago, was that they were keeping their currency relatively low in order to increase their exports, right? That's less of it's less true now than it was then. So let's think about that. So what if we want to sort of reduce the trade deficit, but also keep GDP the same? So if we can achieve a real depreciation, then that's going to shift our net exports up, right? So our ZZ line shifts up, our net export line shifts up, and we would move from A to A prime. That would increase domestic output. That might be too much of an increase, right? It might lead to inflationary pressure, but it will lead also to an increase in the trade balance. Maybe not to a trade balance, but just a smaller trade deficit. But then if we want to get back to our original ZZ line, right, then we can decrease government spending. So we can have a real depreciation, a decrease in government spending that will shift us back to our original ZZ line, but the new net export line stays. And so now we go from C to B. So instead of, we would have gone from like C to a point over here on our new net export line, but instead we go to this point B. And so if we think about, all right, well, if we're a country that has either output that we think is too low, output that we think is too high, a trade surplus or a trade deficit, what are sort of the exchange rate and fiscal policy combinations that we would want to use? So in that case, what we did was we had a real depreciation in order to get rid of our trade deficit. And then we needed to decrease government spending because our output was too high. But basically, if we have low output and a trade surplus, we want to increase government spending. If we have high output and a trade surplus, we want to increase the exchange rate. And then vice versa, if we have low output and a trade deficit, we want to decrease the exchange rate. And if we have high output and a trade deficit, we want to decrease government spending. And the idea is really, all right, well, what is our focus, right? Is our focus on the trade deficit? Is our focus on output? And sometimes we might need to do both. Now, of course, we talked a little bit about, there are still some fixed exchange rates. China definitely had a fixed exchange rate, and they still do to some extent. Not quite as fixed as it used to be. But a lot of exchange rates are floating, and so if you are going to intervene in the foreign exchange market, it can be very expensive to try to change your exchange rate, and so it might not be a feasible possibility. Obviously, one of the issues with the financial crisis in Europe was that all of these countries were using the same currency, so there was no exchange rate. Usually, if one country, say Germany, is doing well, and another country, say Spain or Greece, is doing poorly, then there will be a change in the exchange rate, right? A depreciation from the Spanish point of view or the Greek point of view. And then that will make their exports cheaper for Germany. They'll buy Spanish and Greek exports. They'll go to vacation in Spain and Greece, and that will help lift those countries up. But there was no ability to do that in the financial crisis because there was no exchange rate. They were all on the euro. And so what we can see is that the current account deficits did eventually, they were quite negative in Spain, Portugal, and Greece coming up to the financial crisis. But then it took a while for them to come back, right? And so eventually they did. So eventually the current account deficits were eliminated, but it was not an easy situation. And unemployment rates were extremely high in these countries. And they had, basically a depression level event. So if we look at Greece in particular, which was probably the hardest hit of these three countries, although Spain had a very high unemployment rate as well, real GDP had been increasing. The financial crisis comes, real GDP falls significantly. So it was back to, 2000 levels by 2014, about 30% lower than it was in 2007. Imports fell, as we would expect when GDP falls. Exports fell at first, right, because there was no exchange rate to sort of boost exports, and it wasn't until 2009, 2010 that they really started to increase, and eventually they did. But they still, you can see in 2014, they're still below the levels they were in 2007 and 2008. So without that exchange rate mechanism in Europe, the recovery in countries like Greece and Spain and Portugal probably took much longer than they would have otherwise.